All right, so in this section we're going to go into the detailed version. So if you haven't had a look at the short version, which admittedly wasn't all that short, but we did skim over a lot of topics relatively quickly. So in this section, we're actually going to delve into some of those ideas with a bit more detail, and we're going to pull apart some of the graphs and some of the details so that we can really try to get to a much deeper understanding about what's going on and why, and add some sort of relativity to what's not just what's going on in markets, but sort of how did we get here, what's underlying, what's driving this, because I think that's really, really important if we want to understand, sort of where to from here and what, if any, adjustments we want to be making sort of going forward. So again, with this video, feel free to obviously pause, skip, rewind. There's going to be quite a lot of detail in this, so it's designed to be sort of digested over a period of time. But anyway, let's get into it. So first thing we want to do is, we're going to look at again what's going on from a market perspective and the underlying sort of economics that are driving the current market activity, because it's obviously important to understand that investment markets really, in the long term, are driven by the economy, because it's the growth in the economy that allows companies on aggregate to make more profits. But really, economic news and economic changes really don't have anything to do with market activity in the short term, because the market's a very forward-looking instrument, if you like, and so they're more looking at what type of economic changes that might be occurring now and what impact that might have on the longer term. And so the correlation between the two is much more long-term than short-term. So it's really important, I think, in that sense, to understand, what's in the sense of what's going on, how did we get here? So we'll look at that in a bit of detail. We'll look to see, is there any good news in all this? And then finally, we'll have a look at, what does it mean from an outlook perspective, and what are we looking for in terms of, are there any sort of material strategic changes we might be making in the future? All right, so again, we talked about this in the first video, but I just want to go through just briefly again, really important principles to keep in mind. No such thing as government money or even company profits in that sense. All money, to the degree that it represents wealth that's actually being created through productive activity, is a result of people doing stuff, whether they did it collectively in a company, whether they did that as sort of government services, or whether they do that as individuals. It's all what only people produce stuff. So let's keep in mind that money is the way we move, we call on resources, and moving money around has an impact on that, but money itself isn't wealth. One person's expense is another person's income. There's always two sides to every story. And similar, one person's liability is another person's asset. Really important when we look at, particularly in terms of what the effect of interest rates is in bonds that we're going to look at as well. And again, money is simply a call on future resources. So the whole point of having money, the whole point of having financial wealth, is because we're going to put a call on future resources. And therefore, it's really important what the value of that money is likely to be at the time we're going to be calling on those resources. Having an inflated balance sheet today is of no use to us if the intrinsic value of that, the real potential to call on that money in the future, is nothing more than a bit of a pipe dream. We'll talk a little bit about crypto and how that potentially represents, that type of activity and has been a big driver in terms of a lot of the exuberance of the market in recent times. Only genuine productivity creates wealth, so we've got to be doing things that create value. CPI is in inflation. We talked about that a little bit, and we'll talk about that again. And most importantly, understanding that at any particular point in time, the economy might seem like a zero-sum game because people are trading between themselves, but economies themselves are definitely not zero-sum games. All right, so we're going to look at what's going on. We're going to go through a few different markets, a few different sort of benchmarks, if you like, to sort of try and understand what's happened, from a market activity perspective, and get some context and some relativity of that. So we'll start with the All Ords. So this is the All Ordinaries Index. Is basically the 500 biggest companies in the Australian share market on the ASX by size. And by size, we mean share price multiplied by the number of shares issued for what we call capitalisation. So the degree that a company makes up or is a participant in the All Ordinary Index is a result of its size relative to other companies that are also listed on the stock exchange. And it's simply the top 500 of those. So every quarter, they re-look at that calculation and say, hey, this company's got bigger, it's now in the top 500, so we'll move it in. This company's got smaller because maybe its share price has dropped or it's redeemed some shares or whatever. Another company might have raised a bunch of capital, might have merged with another company and might move into the top sort of 500. So it's the sort of 500 biggest shares on the Australian share market. So it's a reasonable proxy for a spread. The vast majority of earnings, the vast majority of market activities is happening within that top 500. There's also the ASX 300 and 200, which are obviously the top 300 and 200 companies. But the All Ordinaries it's the longest index, been around since 1980, so it gives us a reasonable kind of guide in terms of the market as an aggregate, how it's going. And you can see from this graph, so you can see here, this is the pre-coronavirus sort of period. So the market at the moment has really only just got back to the level, to that peak, if you like, right? So yes, the market's come off a fair bit, if it's measured in sort of, absolute terms. We were, heading well up towards sort of 8,000, in sort of early 2022, late 2021. We bounced around that sort of level, came down a little bit, went back up again, and now we've sort of come off, and the market's come off, sort of 10, 15% from those highs, but it's still only really getting back to that level of, a couple of years ago. So this is getting back to sort of February 2020. Certainly nowhere near the depth we plumbed with the coronavirus sell-off, and pretty much more than halfway up the recovery sort of scenario. So yes, we've had a bad sort of short term, but if you look at from a relative perspective, going back a few years, the market's up over that period of time. So this is really important to understand this when we look at things like, we talk about the principle of trading returns being asymmetric, that if we miss opportunities to participate in the market and the market doesn't come back to that level, then we miss the opportunity to be in the market. So the reason we remain invested in markets, even when we know they're likely to be quite choppy, is because we just don't know how far that retreat may be and how quickly it might recover, and we might miss out on an opportunity, to at least own what we own and have to buy that at a higher price. That's something that we'll never be able to recover. So similar to across, we'll look at some other markets as well. We'll look at the S&P 500. So again, this is the top 500 shares in the US. This is a capitalisation market. So again, it's based on the size of shares. Whereas something like the Dow Jones Industrial Average is the top 30 companies on the New York Stock Exchange, but it's not capitalisation weighted. So it's quite a different index in terms of its makeup. It's just an even sort of share across those 30 companies. So it's a bit different to these capitalisation index. What's important to appreciate is with the capitalisation index, obviously, if a large company, say financials, one of the big miners in Australia, for example, their share price moves a lot, that's going to have a big impact on an index like this. Whereas smaller companies moving a lot, doubling, tripling even in price, is going to have a relatively small impact because they're a very small part of that index. So indexes are driven very much by the big end of town and how they sort of tend to move. But again, over 500, that's spread, to some degree, but keeping in mind that just because there's 500 companies in there, they're not equally participating. So the big end of town still very much drives what's happening with this index. So if that index is made up of certain types of stocks, and we'll see when we look at the NASDAQ in comparison, then if a certain sector dominates an index, like say financials in Australia, and the financials are under pressure, that's going to have a much bigger weighting potentially on that index than if the index was more sort of broadly allocated. But again, the S&P 500, so you can see, the end of last year hit a high of sort of 4766. It's come down a fair bit since then. But again, here's your pre-coronavirus peak. So still well above that at this point in time, bouncing around that level in the last couple of days. So you can see, yes, the S&P's come back, but again, really hasn't come back. It's by no means gone to sort of crash levels in the sense of, yes, it might be a bear market in terms of technical correction, but you can see here up over 50% in the last 5 years, which is the period of this graph, and even over the last couple of years, it's still up despite having come off from its highs. Similar, actually I might come back to treasuries in a sec, but if we'll look at the NASDAQ, similar scenario. So this is obviously a very tech-heavy index in the US, so it's come off quite a lot more in recent times because, again, a lot of tech companies, a lot of NASDAQ-listed companies have been more proportionally affected in terms of share price retreat. It's come off from, up sort of just over 16,000, now back to sort of, under 11, around 11. So quite a big drop relatively, even more so than the S&P, so getting up to more like a third, 30-odd%. But again, going back to the pre-coronavirus high, it was still well below 10,000, so it's still above that level at this point in time. So it's really just sort of we'll talk about this more specifically with a few stock examples in a minute, but we're really unwinding some of the momentum and exuberance we've seen in the last couple of years essentially, and that's really what's happened in the market. So now, why is that? This here is looking at US Treasuries. So it really doesn't matter too much the technicalities of what's behind this graph, but essentially what it means is interest rates have gone up, right? So interest rates have gone up from a relatively low level, coming into, again, here's the coronavirus response, and interest rates sort of essentially plummeting from not overly high levels in the first place. And then we've seen as interest rates have risen as an expectation of sort of return to normal and a bit of a pause, we've seen interest rates accelerate in the last 6 months the first 6 months of 2022. So keep in mind that US Treasuries, so these are, we'll look into the mathematics of these in a moment, but so US Treasuries are essentially government debt. So they're normally $100,000 bills that the US government has issued to raise money to essentially cover government deficit spending. So these things will be issued at a particular coupon rate, and the rate at which they're issued will change based on what the sort of prevailing market activities. But those rates themselves can change as those instruments are traded in the market. So a $100,000 treasury can actually have its face value from a market value perspective can change as interest rates change, even though the federal government still guarantees they'll pay back $100,000. And we'll look at the effect of that in a minute when we look at what changing interest rates can do. And here's our Bitcoin. So again, there's a whole bunch of cryptocurrencies, but Bitcoin is very much the poster child. And in this case, I've sort of gone back a few years again to add some relativity to what's happened to Bitcoin. So yes, in March 2021, Bitcoin hit sort of 87,000 for a single Bitcoin. And that's come off quite considerably. It's now around more like 30,000. So obviously a huge drop, having spiked, previously it's sort of 79,000. But going back to even just December 2018, in December 2018, it was 4,000, having hit a high in December 2017 at 25. So Bitcoin's had this kind of massive run up in its first wave of speculation, crashed all the way back down from nearly $26,000 all the way down to under 4,500. Then sort of traveled along a little bit for a while, got back up, heading up towards the 20, back down again, really sort of gone sideways for a year or so here. And then coming into, the post initial coronavirus scenario, it's just accelerated and has been, highly speculative, going up to sort of 80,000, almost halving before going back to over 80,000, and then halving again. So why is Bitcoin so popular, and why cryptocurrencies become so popular? Well, part of the reason, and we'll look at this again, we touched on it in the first video, but we'll look at it again when we look at the amount of credit creation that's essentially happened in the system. So ultimately, at the end of the day, credit creation is a fancy term for printing money. So when money's printed, more money goes into the system, the price of everything goes up. Because if the economy produces the same amount of goods and services, but there's twice as much money in circulation to buy those goods and services, by definition, the price of everything's going to go up. It's going to double, okay? And so what that means is those who hold that currency or hold money, and if twice as much is printed, the money you did have now only has half the purchasing power it did. So this is what inflation is. Inflation is too much cash, too much money, chasing essentially the same amount of goods and services the economy is producing. So if the amount of money creation is faster, or money creation growth, if you like, is at faster rate than the economy is growing, then there's going to be more physical cash, keeping in mind that much of that now electronic, but it's still money, that cash is chasing the same, essentially similar amount of goods and services, the prices are going to go up. Now that's not great for all sorts of reasons, but the most important reason is it then penalises people for holding cash. So one of the advantages of at least a small amount of inflation is it does penalise people for holding cash, therefore they're more likely to deploy that cash. Now that might be in spending, i.e. they'll buy things that are being produced by the economy, so the economy can then produce more things. And that velocity of money, that movement around, keeping in mind that one person's expense is another person's income, so the faster that money moves around, the more rapidly an economy can create growth. And we've seen that as historically as currencies, have evolved to be much easier to move around. So almost everything imaginable has been used as a currency over hundreds of years. Everything from tobacco to seashells to, all sorts of things. Being natural things that are dug out of the ground or picked up like gold, and elements even to things that are essentially man-made. So the issue that's most important though when it comes to money, keeping in mind that money itself is just a medium for exchange. It's a call on resources. So what do you want when you have a commodity of exchange? Well, the first thing you want to have is you want to have a high degree of certainty in the relative value of that commodity. Okay, you've got a bucket of money, you want to have a reasonable idea that bucket of money should be able to produce, should allow me to purchase certain types of resources at certain amounts. Okay, and I know that because ultimately I've got this money because I've deployed my human capital, I've done something of value to somebody with using my ideas and my efforts, and as a result of that I've been given some money so that I can then use to go and buy the resources that I want. Now, when I made that deal with whoever I deployed my human capital with, and I got my $5,000 or $10,000 or whatever it was, the reason I charged that amount of money is really based on what I expected to be able to do with those resources. And the reason I didn't do more or less is partly because someone else had to agree to it as well, but also I need to do enough to make sure I have enough to generate, to access the resources that I really want to, that I need to live and I need to look after my family. Now, if that $10,000 that I've acquired through the deployment of my human capital, if that suddenly can't buy as much as I thought, or will buy a wildly different amount of resources, then I have much less certainty when I go to make my next contract, next agreement, when I go to my next deployment of human capital. So it adds a lot more knowledge costs and a lot more variability into those transactions. Whereas the more certain I am, I know that my $10,000 is likely to get, this amount of resource, then I'm not going to waste as much time negotiating or having to go back to, renegotiate with different people around how I might deploy my resource. I can just go ahead and do it. Bitcoin, the idea of a blockchain technology. So again, what blockchain technology does is essentially, what they call a distributed ledger. So rather than one bank or one central bank or one place holding the register of the money, in this case the Bitcoin, that register is distributed across computers all over the place. And the advantage of that means no one can change a register without everyone else agreeing to it. So you can't fudge the books essentially. So that means everyone who has a Bitcoin instantly knows whether they really do have a Bitcoin or not, and therefore know its relative value compared to other Bitcoins. The problem and so the advantage of that is no one can go out and print a whole heap of new Bitcoins. There's Bitcoin minings that will slightly increase the supply, but the supply itself is ultimately limited as well. So there's a restriction on the amount of Bitcoin growth, if you like, and that limits the amount that Bitcoin can be, the price of Bitcoin can inflate the price of other things. So it's a great concept in terms of taking governments out of the equation and saying, no one can make my currency, in this case my Bitcoin, worth a lot less than I thought without me really knowing. The problem with Bitcoin is, as a medium for exchange, first of all, we can see from the price of Bitcoin in recent times, it's extremely volatile. So using it as a medium for exchange is completely impractical because I don't know what the value of my Bitcoin is going to be from the moment I acquire it to the moment I trade it to the next person for whatever resources. And therefore, it's very, very difficult for me to judge what type of transactions I should enter into. Because Bitcoin also isn't as fast as money, because it's still with the distributed ledger, every transaction sort of got to go around and be checked. It's nowhere near as quick and instant as we've come to expect, particularly electronic payments or even handing over cash. So it also doesn't have that velocity, that efficiency that we would get from money. But it does have the advantage of not being able to be inflated in the way that currency can be. The biggest problem with Bitcoin or cryptocurrencies as we see them is the fact that because there's no underlying intrinsic value, there's no intrinsic demand for its use. Bitcoin's not used for anything. It's purely a concept, a made-up idea. It's a computer program that we agree strikes a price that we might exchange. But if we change it into real resources and we don't know what the amount of those real resources may be, and at the moment the only way to do that is to change it into money and acquire that money for most resources. Some things might be able to be traded directly in terms of Bitcoin, but certainly not everything. And most importantly, we are a long way, if potentially never, going to be able to pay our taxes in Bitcoin. So there's always going to be demand for money because we have to pay our taxes in Australian dollars. and that helps to underpin the value of our currency. Whereas with Bitcoin, Bitcoin only works as a medium of exchange for as long as people agree that it does, and to the degree that they accept it at that value. And as we can see, because the value of Bitcoin is a long way from being established and stable, it really can't be used as an effective medium of exchange, and it can't even be used as an effective store of wealth, because from one week to the next, you really have no idea what it's worth. So yes, the underlying technology in terms of the blockchain technology has some very strong potential application for exchanging certain things. It has a lot of advantages over gold, for example, because it can be done electronically rather than shipping gold all around the world, which is how large enterprises and particularly governments exchange wealth between them. So there's some potential applications in terms of that. But from a consumer perspective, cryptocurrencies, because the established requirements for a medium for exchange aren't really there and unlikely to be there, it's not likely going to replace currency, certainly as a medium for exchange, and most definitely as a store of wealth. Therefore, all it is really at this point in time is another opportunity to speculate. And that's precisely what we've seen happen to Bitcoin. So, moving on to what's happened now, this graph's a little bit messy, but basically all you really need to understand here is this sort of darker line is resources. This is looking at the Australian Stock Exchange, so mostly BHP and Rio, but looking at the movement in terms of share prices for mining companies versus tech companies. So you can see here that there was a bit of a divergence. Mining companies were sort of, in fact, going backwards as tech companies were going forward, and the reverse has happened. So we've actually seen a huge sort of drop in tech stocks in Australia, whereas mining companies have actually been, well, certainly maintained in more recent times, but also, had a bit of a resurge from an underweight of a couple of years ago. So whilst you might see the market moving in a particular direction, this is a good example of understanding that just because the market itself is up or down doesn't necessarily mean that every company is up or down. But more importantly, there can be entire sectors that are moving completely against the general trend of the market. Now in Australia, when the market, the All Ordinaries Index in particular, is down, that's normally a result of financials and or resources being down because they dominate the capitalisation part of the market. But in this case, we can see that resource companies have actually performed reasonably well through this period, despite the fact that the market overall is down, and that's been very much driven by tech stocks in particular. Again, if we look at healthcare versus financials, so this is financials, which is really mainly the big banks. It's all financial companies, but again, they dominate that. We can see that they're down a bit from their pre-coronavirus highs. Healthcare down, this is the coronavirus here. It's had a more sort of sideways run, if you like. Didn't have the big drop off to the same degree that some other sectors had with coronavirus, for probably relatively obvious reasons. But again, a good example of one of those sectors that you would think probably more intuitively should have been performing a lot better, given the demand for healthcare services and the money sort of put towards certain healthcare services. So despite the fact, we looked at copper as an example in the earlier video, despite the fact that there might seem to be a tailwind for a particular sector, doesn't necessarily mean that that sector is going to perform, going to turn that tailwind into, short-term performance. All right, so what's the shock? Why have things changed a bit in recent times? Well, I think this graph probably sums it up in best. So this graph is looking at the expectation for interest rate movements. So basically what central banks, in this case the US being the Fed and the RBA for Australia, what the expectation, so this is the bond market, fixed interest market, their expectations on where they think interest rates were going to be. Now, how do we know what they think? Well, because that's what the bond market yield curve essentially tells us. So if we go back to December of 2021, so not that long ago, but sort of good 6 months now, we can see here that the expectation was rolling out to sort of, end of 2023, that interest rates would sort of make their way back up to sort of about 1.5%, from, Australia's position of sort of 0.1 was the official rate, and the US it was a little bit higher than that. But the idea, or the market expectation, was that interest rates would relatively slowly rise over the next couple of years. The RBA was saying It was sort of no rises until the end of 2024 at one point. The market expectation is, rates would hit, 1.5 to 2% sometime in probably towards the end of 2024. And as you can see, that changed quite substantially. So 6 months later, and now in June, you can see the expectation is not only a rate's going to rise much more sharply, and so by the end of 2023, we'll be already up to over 3 and 3.5% in Australia, 3 in the US and over 3.5%. And that change in interest rate is really what sort of set the market volatility that we're seeing at the moment, is that resetting of expectations. Now, where do we sit in terms of this? We certainly didn't think this was the case. We certainly thought interest rates would normalise. Keep in mind, we probably want to be around more like the 2.5% mark as a minimum anyway, because the rates we were experiencing were massively artificially low, and that makes money far too cheap and sends a lot of the wrong signals in the economy. So we really didn't want to stay there because resources aren't allocated very effectively when money's too cheap. So we really, needed to get back to that sort of level. Our expectation was we would get to there a lot sooner than the market was predicting here. But our best guess at the moment would be also that we don't think that this is likely either, simply because that rate of increase in interest rates would have a very dramatic effect on many different things in the economy, most importantly asset prices and spending patterns, and would definitely threaten at least a technical recession both in Australia and the US. Now, there's lots of reasons why that's unlikely to happen, particularly things like unemployment levels, etc., and also the relative health of household balance sheets. But a very sharp rise in rates, yes, it's only a couple of percent, but it's a couple of percent from a very, very low level. So from a percentage increase in perspective, it's quite substantial. So, and the other thing to appreciate, this is more of a feature of the US market, that the housing market in the US is predominantly a fixed rate market. So interest rates there feed into their economy much faster than they do in Australia, where we all tend to be largely on floating rate interest rates. So we sort of meander our way up, whereas in the US, once the interest rates, the expectation goes up a couple of percent, so does all of the home loans people are buying from that point on. So you go from being able to buy a 1.5%, 2% home loan rate today, in a few months' time, you're suddenly paying 3.5%, 4% because those rates are fixed for, sort of 10-year or 5-year terms in some cases. So the effect in the US market is much more rapid of interest rates than they are in Australia. And that has a huge impact in terms of valuations. So let's look at, first of all, bonds, right? So bonds are often considered to be a very safe investment, particularly government bonds, because the government essentially guarantees the $100,000 that you lent them, they'll pay you back at the end of the 10-year or 30-year, whatever period is, but they'll also pay you the coupon rate, whatever the interest rate is. However, everything has a market price at a point in time. That is, what would I sell this for based on the prevailing market conditions? And the thing about bonds that people don't necessarily appreciate, twofold. One is they're used to set what we call the discount rate, so how we value other things, because they're deemed to be what we call risk-free. Because if the government can't afford to pay you, well, then probably no one else can either, because the government get their money from everyone else. So at the end of the day, that's a good barometer to everyone else is broke if the government's broke. So, but if the government's broke and everyone else isn't, they can bail the government out, but not so much the other way, because again, people create productivity. But what happens with a bond when interest rates change? So in this example, in a really simple sense, when interest rates go up, bonds go down. When interest rates go down, bonds go up. So we saw that on the way down as interest rates dropped. Bond markets had relatively strong returns because of this effect. So let's look at one. In this case, we'll look at a 10-year and we'll look at 30-year and what that does for the value when interest rate change. So we start at 5%. So, we're at a point in time, the government's wanting to borrow money. So they're issuing treasury bills, $100,000, and we'll pay 5%. In other words, we'll pay $5,000 a year for 10 years. And at the end of the 10 years, you get your $100,000 back. That's a guarantee you're getting from the government. Or in a 30-year example, $5,000 a year, and you'll get it for 30 years. Now, that credit risk, the risk of the creditor, in this case the government, paying you back, really doesn't change. You could argue it changes a little bit based on how indebted the government is, etc. But in a general sense, the reason it's a risk-free rate is because the government is going broke. They can either A, print more money, or B, tax their citizens more. The government's always got access to money to pay you back, okay, at least in theory. Now, what happens though if interest rates change? So if interest rates were 5% and interest rates have now dropped to 4%, Now when the government issues new treasury bills, as they're doing all the time, they can now issue them at 4%. Okay, so the amount they only pay you $4,000 a year for the 10-year period or 30-year period. So if you're a holder in the market of a 10-year treasury bill that's paying 5%, and now I can only go and buy one from the government that's paying 4%, your bill is obviously worth more because it's going to pay me $5,000 a year, where the government's only going to pay me $4,000. So that increases the value. And basically all it does is increases the value to the point where the amount I would pay for that bond to create the same net income return, 4% yield is higher. So in other words, my $100,000 bond becomes now worth $112,000, but a 30-year bond, because obviously that's a much longer period, goes up more like to $166,000 in value, because that's the amount, if I paid that much, I would get that 4% return, being the $5,000 4% return over the entire term. So this is obviously the extreme. We're talking about rates going up straight away. Throughout the term, that would, with the term to maturity, that changes. But you can see, a 20% change in rate, only 1%, and we get a 12.5% change in value to our 10-year bond. But we actually get a 66% change in value to our 30-year bond, which obviously is quite extreme. Again, we dropped to 3%. We now need 125. It's now worth 125,000 because that's what we would need to get that same rate of return. We've seen a 40% drop in the rate, but we've seen a 25% increase in the value, and with a 30-year even more so, it's more than doubled. Now, the same or the reverse is true on the upside. So if we went from 5% bonds to 6%, now because the government's issuing 6% bonds in the market, and if I own a 5% bond, no one's going to want to buy my 5% bond for $100,000 when they can get $6,000 a year for that $100,000. So I'm going to have to sell my bonds at a discount around $87,000 so that they'll get a 6% yield for the term of their bond, or around $33,500 if they're going to get that yield over the term of a 30-year bond. So obviously the sensitivity of time is extreme here, to the point where if interest rates went from just 5% to 7%, it becomes negative. Right? So that's why we see, and we saw this in Europe in particular in recent years, you can end up with negative returns. People get paid to borrow money because of that yield differential. A relatively extreme scenario, but that's certainly what happened when rates sort of hit zero. So bonds, again, keeping in mind that none of this alters the credit risk. In this example, you're going to get your $100,000 back at maturity, and you're going to get the promised coupon rate. But because the alternatives in the market have changed, the value of yours from a market value perspective has changed accordingly. And the same thing is true for valuations, and particularly of companies that we're setting a discount rate of how we value companies based on interest rates. If that discount rate has increased, then that's going to reduce the future value of those earnings and therefore reduce the valuation companies. So interest rates, and one of the reasons why we keep an eye on that 10-year treasury curve in particular, is because that actually sets a lot more of the expectations of future market returns than just what home loan repayments are going to be. All right, so let's move into looking at what I call the post-COVID surge, and sort of again we're looking into what's happened in the last couple of years. How did we sort of get to this situation where we've sort of got this volatility? I think this is probably one of the best graphs to really show. So this graph is looking at Tesla. Tesla obviously is an electric car company. Well, it's mostly an electric car company. I've seen everyone justify Tesla from a platform to a technology company to a data company, lots of things, but the predominant product they make and will make for the foreseeable future are electric cars. Now, whilst there's widely different views in terms of Tesla as a company, wildly different views in Tesla in many respects, it's reasonably universally accepted that Tesla's technological advantage, and particularly their manufacturing advantage for electric vehicles, are well ahead of the market. There's no car manufacturer who produces electric cars as efficiently and as well as Tesla does at the moment. However, this graph here looks at Tesla's capitalization, so the value of Tesla shares. Again, capitalization is the share price multiplied by the number of shares on offer, versus every other car manufacturer combined. Okay, so we see back in 2019, Tesla was tiny compared to Toyota, Ford, Daimler, all the other car companies, Kia, all those car companies combined, BMW. were, a dozen times the size from a capitalization point of view of Tesla. Over the last few years, though, Tesla's share price, because of its accumulation, has reached the point, by sort of, late 2021, where the market value of Tesla as a company was greater than all other car companies combined. Okay. Now, Tesla makes the most electric vehicles, but it's a long way from making the most vehicles, and it's certainly a long way from making more vehicles than every other car company combined. So for this to be true from a valuation intrinsic value perspective, Tesla's ability to grow its earnings based on its capital value now, not its earnings now, but based on its value now versus all other car companies, would have to be at least as strong, if not stronger, than all other car companies combined. Is that possible? Sure. Is it likely? Of course not. So the appreciation in Tesla's share price has got nothing to do with the fundamentals from a predictable future earnings possibility. It's all to do with, to the degree that it's to do with anything rational, that a market expectation that they will dominate the electric car market and take significant market share permanently from all other vehicle manufacturers. Now, if that turns out to be true, then Tesla's share price may be justified around these sorts of levels. But if anything other than that becomes true, then Tesla's share price is almost certainly massively overvalued. Now, Tesla's an easy one. It's for a long time been the most shorted stock in the world, and a lot of hedge funds have gone broke chasing that because the Tesla share price has continued to accumulate despite being the most shorted stock in the world. But let's have a look at Google. So in this case, Alphabet, which is a parent company of Google. So Google's revenue has grown, fairly consistently for a long period of time, but particularly in the last couple of years has exploded, particularly coming out of the coronavirus pandemic response. So we can see, back in 2018, Google's rolling income, so it sort of dropped off a little bit in 2018, but back to 2020, pretty solid, a little bit of a blip here in terms of coronavirus, but then from there it's just accelerated. And probably the one number here that really sort of stands out to me was that their annual net revenue for 2021, increased 88%. So here we're talking about a relatively mature company, a technology company, arguably, but here we're talking about a company that essentially sells advertising revenue. That's nearly all of their revenue comes from advertising. Yes, they've replaced traditional media. Yes, they've replaced a lot of traditional advertising, and there's still a lot of money being spent in those spaces that Google could potentially take over. But they've got competitors like Facebook and Snapchat and TikTok and all the other sort of social media platforms. But for a company the size of Google to grow its revenue stream, to almost double it in a 12-month period, is almost certainly unsustainable for a business as mature that is essentially really just a media business selling advertising. Now, a lot of that was obviously driven by a lot more people being at home, a lot more people being locked down, a lot more people being online all the time in terms of communication, and that would have boosted their click-through and click rate and revenue quite considerably. Now, is that a sustainable reset? Almost certainly not, but as a result of that, Google's share price has accumulated fairly substantially as well. So this is another example of where looking through the noise and looking through and to say, okay, well, is there a fundamental shift here? Is there a short-term blip and we'll return to normal? Or have we moved to a new plateau, but it's a plateau? We've just moved up to this level and now we're going to sort of drift on similar to what we were in the past. So anytime you see that sort of return, from a company earnings perspective, it's a bit of a red flag in terms of your valuation models, particularly if interest rates are likely to reverse. Your valuation models are going to certainly come under some strain. But what's actually happened in these stocks? So here's, again, Tesla. So this is Tesla over 1 year, and the share price is up, right? It's basically flat, right? Up about 4% in terms of this graph, but basically flat over a year, despite having, being down in the last 6 months, being down nearly 30-odd%. And in fact, from its high, you can see here about 6 months ago, it was sort of the $900 mark. It went up to sort of $1,200. This is when Elon first became the richest bloke in the world. It then sort of ran down, boosted its way back up again, and then has run down to this sort of level. So yes, it's been highly volatile and has certainly been very much under pressure in the last 6 months. But the run up that it's had prior to that means it's actually flat over a 12-month period, despite the fact that it's had some pretty extreme movements in that. So is the Tesla story over? Certainly not, but there's been a huge unwind of the run-up that happened at the most recent kind of run-up in Tesla. Let's look at Shopify, another example here. So Shopify, for anyone who isn't aware, essentially, the cart, your sort of shopping cart on online and in your e-commerce platforms for online shopping, Shopify is one of the dominant players in that space. So you can use Shopify to build a whole website and run a whole e-commerce business, but they're essentially the checkout, the e-commerce sort of side of the business. Now, again, we can see over the last 6 months, the share price is down 74%. It's literally fallen off a cliff. Now, why is that? Well, because the volumes of increased in online shopping that came as a result of the coronavirus sort of lockdowns globally meant Shopify's revenues certainly started to head through the roof. But here's Shopify over the last couple of years. So we can see, yes, it's fallen off a cliff, but it ran up the cliff in the first place. So again, going back to this is the coronavirus sort of hitting back here, okay? And there's a little bit of a blip as the coronavirus first hit, and then Shopify basically just took off from well under 500 to sort of getting up well over $1,500 a share. And yes, it's fallen off an absolute cliff, but over the last 5 years, it's still up over 300%, despite the fact that it's come off a long way. So we're talking about some very extreme valuations here. And we talked a little bit about that in the first video when we looked at that growth versus value disconnect we've been talking about for a while, that we had this huge run up in growth stocks, Shopify being a very good example of that, that weren't underpinned by fundamentals. They're underpinned by a temporary change in behaviors. And obviously Shopify is not the only online e-commerce business, regardless of how extreme it might have in from a market share perspective. And this really, again, similar to graphs you looked at in the first video, this really sort of demonstrates that. So this is looking at US software enterprise value. So this is any software company in the US. Their enterprise value basically being their capitalization value that we talked about as a share of their sales multiple, right? So how many times sales is this company valued at? So is it 1 time sales, 3 times sales, 5 times sales? Because most of these companies don't make any money. So we can't have a multiple of earnings. We can't have an EBIT, what we might use for a normal valuation. So they tend to be valued on multiple of sales. And we can see back in the tech wreck, if we look at US software company and multiple of sales, they got to extreme levels, more than 6 times sales. So not profits, because they're not making any profits, but more than 6 times revenue as an average for US software companies. But in the post-coronavirus sort of surge, if you like, that's got to almost double that level. Well, getting sort of 10 times sales. So again, not based on earnings, not based on any earnings, they're long-term sustainable earnings. And that's what we've seen sort of come off. And that's that sort of the unwind I talk about in terms of growth versus value in particular, but we see that return. But we're only just getting down now to those .com type valuations. So this is one of the reasons why we talk about in the first video is that this surge and sort of washout is very reminiscent of that period of time. And the tech boom was a very unique time for a lot of reasons. It was more of the same, it was just another bubble in many respects, but it was a very different type of bubble in the sense that it was based on a very broad range of companies based on a technological promise that technology will be the driver of profit in the future if you can just get the sales up. Now, some companies came out of that proved to be quite successful over a long period of time, Amazon and Google being really good examples. But the price you pay ends up determining the return. So if we buy companies that might grow their revenues very strongly over the next decade, but we pay so much for them that we only end up getting to a point of justifying the valuation, over that period of time, we don't make any money because we're not making any profits during that period either. So despite the fact that things have come off a little bit, we can see from here that there's still, a reasonable way to go in terms of the growth end of the market valuation. And the reason that I think that's important is because that means we've got some unwind to go, which is certainly positive for value stocks. But it does mean that there's going to be continued volatility potentially for the next sort of 3 to 6 months. All right, so how did we get here? What caused all this in the first place? And why aren't we better sort of prepared for it is probably the more sort of obvious question. Okay, so in this graph I want to look at this is the expansion of balance sheets for central banks around the world. So this is the Fed, the RBA, Bank of Japan, etc. So we can see going back to early 2000s, this grey line here is the Bank of Japan. Now, Japan's been a bit of an economic basket case for a long time for a whole host of reasons, but particularly because their government balance sheet's been anemic, to say the least. And so, globally it was well understood that, Japan had very little firepower to be able to kickstart their economy because they were already, as a percent of their GDP, that they were already very exposed in terms of their the Bank of Japan's sort of balance sheet. They started to try and do something about that coming into the GFC, but as a result of that, they've had to drift back upwards, as most economies have, because the response to the GFC was to print more money. If we look at somewhere like the European Central Bank or the Bank of England, much more modest level, particularly in England, but a bit of a kick up here. And then as a response, this is the GFC period here, we can see a universal kick up of money essentially being printed, especially by the Federal Reserve. Now, this is a comparison to GDP. Why is that important? Well, it's really important because the size of a country can make the numbers seem almost irrelevant. $1 trillion in the US is very, very different to $1 trillion in, Haiti. So we really, when we look at this sort of data, we really want to compare. We want to try and compare apples with apples as much as we can. And so the best measure of wealth is relative to its wealth. So yes, the US might have a deficit of X dollars, but that deficit in another country could be catastrophic. It's relative to the wealth of the country. So whenever we look at things like this, we always want to be measuring against the relative wealth of the country. So in this case, we're looking at nominal GDP. But what's important to understand here is, basically central banks have been growing their balance sheets. Now, what do we mean by growing their balance sheets? Well, keep in mind that at the end of the day, the Federal Reserve, it controls interest rates. All central banks try to control interest rates to influence the rate at which banks create money, all right? Increase the money supply. By putting interest rates up, banks are less likely to grow credit, okay? Credit growth slows, i.e. money creation slows, and therefore you're less likely to create more money than the economy is producing goods and services. Because again, if the goods and services are going up by 3% a year and the money supply is going up by about 3% a year, then prices are basically stable. If money supply is going up at a faster rate, then prices are going to be going up. That's what inflation is. If the money supply is growing at a slower rate than the economy, then you get into a deflationary situation, and that can be potentially significantly worse than inflation. Okay, but what's important is that relative balance. So it's okay for money to be created at any rate, provided that rate relative to the growth of the economy is reasonably in check, because then we won't get actual inflation. Okay, so what's actually been happening? Well, so what the Federal Reserve and other banks around the world have done, particularly coming out of the GFC, is because interest rates already got to a very low level and were proving to be relatively ineffective in stimulating more credit growth, what the Federal Reserve decided to do was to begin what they call quantitative easing, or QE. So what do they mean by that? So what they did is they basically went out to the market and said, we'll create new money and we'll buy bonds out of the market. Okay, so banks or governments have issued debt. So, banks issued, the government's issued $100,000 treasuries, put that in the market. That satisfied a certain amount of demand of people who were investing in fixed interest. But if the Federal Reserve comes along and says, no, look, I'll buy that off the market to create new capacity, because now I've bought it off an investor, that investor's got cash, the investor they want to redeploy that in bonds or fixed interest, they'll want to buy fresh issuance. So it allows banks and central governments and governments to issue more credit to grow the money supply, because the more they do that, the more the Federal Reserve's pulling that money out of the market, if you like. So, and sticking on their own balance sheet. And the effect of that simply means that they're able to drive the price of money down, which increases credit growth, and that means the supply of money. So what does that look like in the long term? So if we look at, keep in mind that this graph here, I've only deliberately gone to 2013. So this is like 7 years before coronavirus. This is just looking at the response to the GFC. It was print money. Okay, so then if we roll forward and look at how does that compare to history? So is this something that's been done before? Well, yes, it is, and particularly when it comes to wars. How do you fund a war? Well, you print a lot of money and you try and get people to buy those bonds. Now, Here's the surge in the GFC from the Federal Reserve. And so again, we're looking at percentage of GDP because we would need to measure wealth relative to the wealth that we're talking about. You can see here the Great Depression. We got up to sort of 23%. The end of World War II, we got up to sort of 20%. And we got up to sort of, by 2011, we got up to about 19% of GDP in the amount of money created or sitting on the Federal Reserve balance sheet. So we're talking coming out of this GFC from a, not a historic low, but a reasonably low level, a huge surge in money supply as a response to the GFC. Now, why was that? Well, because keeping in mind the GFC was a banking crisis. Many banks ended up going under and many banks needed to be bailed out. In other words, they weren't there to create credit growth. So the Federal Reserve stepped in to take over that job, right? So yes, it looks like the Federal Reserve balance sheet expanded a lot, but the argument at the time, particularly by Ben Bernanke at the Federal Reserve, was that we're essentially taking over the role of banks because banks aren't in a position to do that because they've just blown themselves up because of the subprime crisis predominantly. So the Federal Reserve was performing a function to get over a banking crisis. Again, if I go back to the tech wreck was not a banking crisis, just as the current situation is far from a banking crisis, but the GFC was quite unique in that it was a banking crisis. And it meant that the flow and the supply of money was under threat. And that ultimately means economies can't function because the velocity of money will essentially stop and economies will end up falling over because people now can't efficiently trade their resources. So that was arguably a reasonable response to the Great Depression, and arguably a reasonable response to wartime. That's the only way you can fund a war, and arguably a good response to a banking crisis. If we roll forward though, and have a look at what the response was. So this is looking at, in this case, the St. Louis Fed, but the Fed in the US, and looking at what their expectation was. So again, we're going back to 2013. We're rewinding history here to see what the story was and the message and how will they deal with this crisis and what will come out of it. So you can see here that they're interested in headline inflation, which is, we talked about a little bit in the first video around what is the change in prices. But they're more interested in sort of core inflation, i.e. what's the underlying change in prices in the economy? Is that getting out of control? And the target rate being 2%. In other words, we want the money supply to grow at about 2% faster than the economy. So prices are basically going up over time. It's beyond the scope of this video to explain why that's a good idea, but that's essentially what the Fed's trying to do, trying to grow the money supply slightly faster than the economy. But because you can't measure that, certainly with any precision and certainly not in real time, it's always a bit of a juggling act to look at what's happening with CPI. They call it PCE inflation, but they're really talking CPI. So the measure of prices, how is that changing? And they want their target to be 2%. And you can see, coming out of the GFC, well under that, nothing to see here. It's all good. And not only that, here's our expectations. So at this stage, this was a forecast, right? Expectations, they always revert to mean. Okay, we think we'll just drift back to that by 2016, 2017, and everything will be okay. That's the story at the time. And in fact, if you look at the report, the conclusion, this is the report, you can still find this on their website, that the unconventional monetary policy, so the unconventional policies they're referring to there, is Bernanke's argument that the reason he was allowed to print all this extra money was because the government normally issues a treasury bill, we talked about that before, let's say a $100,000 treasury bill with a certain coupon rate. And that's the promise from the government to repay that money and to pay the coupon. Bernanke's argument at the time was that that is the same as a dollar bill. So a dollar bill is a promise from the government to exchange a resource to that value, but it has zero coupon. You don't get any interest by owning cash. So his argument was he was essentially, by printing money, he was just issuing more, essentially, government treasury bills, but this time with zero coupon rate, i.e. no interest, and using that as a way to drag interest rates down, to stimulate credit growth, to keep the economy growing. That was the argument. Unconventional because it had never been done before. In fact, it was outside of the Fed's scope to be able to do that. That's why he had to do this sort of sleight of hand and say, no, I'm not printing money, I'm creating government debt, essentially. Now, this is the Federal Reserve's sort of justification. And they're saying, look, it was instrumental in avoiding a depression. That's probably an argument for another time. But most importantly, it's greatly expanded the defence balance sheet, similar to other times it's been required in history. But in the coming years, they'll need to reconcile the extraordinary amount of excess reserves with the healthy economy. They understood at the time, you can't do this and expect to get away with it. We're going to have to take some action to get this under control. But good news was they have several tools at their disposal that will afford significant control over the excess reserves. Don't worry, it's not going to get out of control, and it will allow them to take timely action in order to stabilise this, and it's not going to blow up and get out of control. We're not going to have to worry about inflation. That's the argument. Okay, but here's essentially what's going on. So I've stuck a little line here around the sort of roughly sort of 3% mark and say, okay, well, if this is the rate of growth in an economy, and economies worldwide, globally, 3% is probably a little bit low for global economic growth in the long term, but it's not unreasonable. And here's the money supply in the US. You can see that it's almost never, in the last 20 years, almost never been that level. So, here's coming out of the GFC. Here's the first bit coming out of the GFC. Then there was a bit of a contraction. Things are getting out of control. You might remember in Australia, our interest rates went up, got back up to sort of 6-7%. Then it all got sort of, pulled back down quite considerably before realising, oh, hang on a minute, let's put a bit of brakes on things, and more money got printed. So we get in this situation where here we can see that that our credit growth, this is the money supply now, right? The amount of money in the system growing at clearly a much faster rate. We're getting up to sort of 10% at this level here, but 5 at least on average, versus economic growth of more like 3 to 4. So it's growing faster than the economy, okay? So that's already a bit of a concern, especially when we get these sort of really sharp spikes. But here's the coronavirus response. It's taken it to a whole nother level. So we thought that there was an extraordinary amount of money printing back here, right? This is just one of those kind of hold my beer kind of moments, right? This is just, let's just see how crazy we can go. Now, we've seen a rapid reduction in this, but keep in mind this is the increase in money supply. So the fact that this line has come back down again means they're still increasing the supply of money much faster than realistically could be expected from economic growth. They're just not doing as fast as they were. So this isn't a recovery or retraction. This is just the engine's out of control. It's now, it went from being crazily out of control to just being a little bit out of control. So the money supply is continuing to increase. And that's why we are absolutely going to be faced with inflation, because inflation is, as we've talked about many times now, it's more money than there is goods and services in a relative rate. So if we look at that just in terms of, this is the Fed's balance sheet. So again, you don't have to worry too much about the makeup of this. There are all sorts of different instruments, but those different instruments are there to make it look like they're doing different things. But at the end of the day, it's all printing money. We can see, again, here's the response from the GFC. So a bit under $1 trillion, which for the US, we know looking at from a GDP perspective was not that bad, and certainly by other central bank standards, not terrible. We can see that a lot of money was printed in a short space of time, and then that was expanded when that wasn't creating the desired effect a few years later, and we had an expansion out to more like 4 trillion. So not only did we print $1 trillion here, another 2 trillion was printed here. And finally, by about 2018, as things were sort of getting back to normal to a degree, we started to see the Fed, start to taper in terms of that. Along comes the coronavirus, and we go from 4 trillion to closer to 9 in 18 months. So again, we virtually doubled the amount of money on the Fed's balance sheet. That's a very significant increase in potential money supply. Now, it's not money in the system necessarily, because it's a bit of a sleight of hand at this point, coming in and out, but it means there's money in the system. And so similar to those comments we saw from the St. Louis Fed saying that they have tools at their disposal and they just have to drag it out of the market essentially at the right rate. There's one argument to say that they could do that at that level. Then we're now talking about a whole nother level of potential withdrawal here, and to do that without creating any economic pain or any retraction in asset prices is basically just impossible. So what is the effect of that in terms of markets? Well, this is probably the best example of that. So here's the S&P 500. So this is the dark line, if you like, overlaid against that Fed balance sheet. So that line we're just looking at. So you can see again, getting into sort of 2017, 2018, it started to contract a bit, but then the coronavirus hits and away we go. Now the market continued to run at that point, as we can see here. There was a bit of disconnect, and it started to wake up to itself. But ultimately, we can see as the Feds printed more money, it inflates asset prices. We've seen that absolutely in Australia, particularly in house prices, because of the effect of interest rates on our housing market in particular. Again, because of variable rates, we go down very fast. But what we're also seeing in the US is we're seeing asset prices, in this case, particularly those growth tech stocks in the US, those prices growing quite considerably simply because the amount of money in the system inflates them. So that's why we're seeing now a retreat, because that has to be unwound. Now, will that affect the value part of the market? It will in the transition. How much, we don't know, and hence we're not going to try and speculate and trade our way through that. But the good news is it is taking a lot of the potential heat and the potential bubble sort of out of the market that we've been somewhat concerned about for the last couple of years. Again, just want to touch on inflation, keeping in mind that inflation being too much money, but prices are driven by so many other factors. We looked at this graph in the first video, but again, probably the key bit of this is there's a lot of deflationary factors in economies all the time. And so depending on where you sit in an economy in terms of your spending habits, if you're very much spending in that, medical and utilities is a big part of your expenditure, you're going to get hit much more substantially than those people who are essentially, spending most of their money on sort of technology-based or clothing, footwear, those sorts of things. But everything's going to be increased in at least price, because the costs of everything are going to feed through with increasing prices for energy in particular, and labour, because there's very few countries left in the world where we can continue to export cheaper labour. So, now for the good news. There is a little bit in the sense that things are returning to a more normal market activity, which will reward investing more sensibly and ensuring that companies with sustainable earnings are the ones that attract capital at the most reasonable prices. So that's probably the really good news. But most importantly, and I sort of bring this graph out sort of every time, the really important thing to understand is regardless of market volatility, as long as the economies are growing, okay, the ability for companies to generate more profits is growing. Now, what we may see in this round, and we've seen it in particularly the last sort of 12 months, is the amount of mergers and acquisitions, and in fact, the delisting of many, particularly large companies and particularly large infrastructure investments in Australia, means that the market itself is starting to shrink in relative terms, because less companies are being listed and those companies aren't growing, because many of the best companies and many of the best assets are being taken off the market. So that's certainly something we'll need to keep a bit of an eye on, because there's a lot of very large sovereign wealth funds, pension funds, lots of big pools of money around the world that are looking for high quality assets, and we certainly do have quite a lot of those in Australia. So we expect merger and acquisition activity to continue to remain strong, because the underlying economic position in Australia is reasonably strong, which means profit growth expectation as a whole is likely to be strong for many years. And we can see, going back through 1980 all the way through to 2020, despite the fact there's been, there was, the tech wreck in there, there was a crash of 87, there was a bond market crash in 94, there was the collapse of long-term capital management and the Russian debt crisis in the late 90s. There was a recession in the early 90s. There's the tech boom and crash in 2000s. There's a Gulf War. There's both Gulf Wars. There's lots of things that have happened both locally and globally that essentially haven't derailed economic growth, and therefore that's also unlikely to be an issue for us going forward either, because at the end of the day, growing economies mean companies can make more profits. And probably the last a look in terms of dividends is this is from Janice Henderson's Global Dividend Reports. The first quarter of 2022 was a record period for dividends around the world. So dividend growth and the payout of cash flow from companies continues to be reasonably strong, because in general, there are many companies around the world with very strong balance sheets and very reasonable prospects for growth. So a lot of the high flyers are disappearing. A lot of the high flyers are certainly under a lot of pressure. But in terms of good, solid opportunities to invest, there's still plenty of those. Yes, they'll come under pressure as market volatility is increased. But there's the danger of permanent loss of capital is extremely low. Okay, so the outlook. Well, the good news is there's plenty of places that are actually in pretty decent shape, and China is certainly one of those places. So now that doesn't necessarily mean that we're going to be sort of tilting towards China in a major way, but China is now a very significant part of the global economic story. Sure, there's some geopolitical risks, but while the US tech stocks have been sort of blowing up, China is sort of been recovering from a bit of a real estate bubble of a couple of years ago. So this is looking at Chinese credit growth. We touched on this in the first video, but I just want to make the point that this is zero. So in a Chinese economy that's growing more sort of 5-6% at least, credit growth as a percentage of GDP negative means that they've got plenty of room for stimulus, plenty of room for printing money themselves, unlike certainly the US. And to give you an idea of that, from a relative point of view, so this is the money supply in China, okay? And again, China's GDP through this period was extremely high. And yes, it's come down a bit, but it's still very, very high. Whereas the US, their economic growth has not been anywhere near as high, and yet their money printing sort of been out of control. So there's no huge spike here that coincides with, the US and particularly sort of parts of Europe. So China in particular is in pretty decent shape, and there are other parts of the world that certainly are as well. So the last thing I want to kind of leave you with here is well, have we been here before? Yeah, we've had lots of periods of rising inflation, and the 70s and early 80s is probably the best example. And we know what does well in those environments. We know where the tailwinds are likely to come. Now, again, just because there's a tailwind doesn't guarantee future profits. So it's not like we can just go out and buy stocks in these sectors and we're guaranteed to make money. But there is opportunity. There is opportunity against inflation heads, gold being one of those. Gold, however, not being an asset because it doesn't produce income, it's a store of value. So we certainly won't be sort of rushing out and buying a heap of gold, but looking at things that are inherently good stores of value is certainly going to be an important part of it. But you can see here, most importantly, this is looking at value companies around the world. Value companies do well in the long term, but they do especially do well in periods of high inflation, because quality companies with good earnings have pricing power, have to degree of market dominance, etc. They don't rely on future sales to keep themselves going. Commodities, obviously, so this is going to be sort of energy and resources in particular. They're going to do well through that period of time, almost certainly. Emerging markets tend to do well, which a lot of people find fairly surprising. Equities, growth equities can still do reasonably well in that period, just growth doesn't tend to do as well as value. And what tends to not do very well is the NASDAQ and US stocks as a whole, because the NASDAQ is very tech orientated and tech relies on growth in sales, which will, things like pricing power, etc., will be under pressure. And because the US equities are dominated by many of those sorts of companies, that's why through that period of time, and certainly our expectation going forward would be that the US markets as an aggregate certainly may be under pressure, but that doesn't mean that there won't be good opportunities for good solid earnings in the US. Similar to Japan, the Japanese market's been underwater substantially since the 1980s, late 1980s, but there's been very good Japanese companies making very good earnings through that period of time. So just because the market might have a bit of a headwind doesn't necessarily mean that there's not going to be good opportunities in those markets. So in conclusion, the good news, at least I think from our perspective, is that what you own, it really does matter. The best way to protect your future purchasing power is to make sure that there's intrinsic value in the things that we own. So that hasn't mattered as much for the last couple of years. As I said, it's been very similar to what we experienced in the late 90s in the tech boom, but it's lasted a lot longer. It's gone much more extreme, but it's definitely, back to mattering again. So at the end of the day, cash flow is still king. So, and by cash flow, we really mean free cash flow in the enterprises we own. So not what their share price is, not what their promise of tomorrow is, but what's their ability to generate free cash flow, i.e. profits above what they need to reinvest in the business to grow. We don't want to own a software business that needs to keep ploughing money back in for more people at higher wages to write more code so they can stay ahead of their competition. When at the end of the day, yes, their software might make people more productive, but other software can do a similar job and can be relatively easy to replace. There's no real economic moat in many of those sorts of companies. We are at the end of a long cycle, so the short-term business cycle, if you like, short-term debt cycle tends to be around the sort of 7 to 9 year mark. We definitely want at the end of those cycles, but we're also at the end of the very long-term cycle, and that is we've got to the stage where federal governments and ultimately then their central banks have created more money than they can realistically repay. So we are going to see the effect of that, and that means we are into this period of what they often refer to as stagflation. What does stagflation refer to? It means inflation, but economy's not growing. Now, whether that plays out in sort of the measurement sort of sense, that's likely to occur on aggregate, again, because of the size of things that are going backwards, but does not mean that there's not opportunities to continue to make reasonable long-term earnings growth out of the right sort of companies. And because the world isn't homogenous in this respect, we're not talking about global markets all going through the same thing. We're talking more sectors of the world. There is going to be opportunities for us to continue to generate good earnings growth, to continue to top up our stable pools, which means we can continue to draw on income. So we're not going to have to live, we're not going to have to change our lifestyle expectations based on the fortunes of the share market over the next couple of years. Precisely why we have our stable pool and precisely why we invest in those companies that have relatively predictable earning streams over the medium term. So I know that's a reasonably long one and we've gone into a fair bit of detail there, but I wanted to go through and break some of those down so that, for those people who have asked us in the past, Kay can explain that one in a bit more. We're going to put all in one video so that you can sort of chop it up and look at your leisure. So hopefully you found that informative. If you've got any other questions or there's any topics that I didn't cover or some areas you'd like me to go into, some other examples or differences, we're always happy to look at that. So thanks for watching and we'll see you next time.